You've been paying for protection you'll never use. Right now, millions of people are handing over their hard-earned money for insurance policies that deliver almost nothing in return. In this video, we're counting down the 15 most useless insurance policies, what they really do, why they get pushed so hard right now, and how to spot the traps before you pay for them. Number 15 is the little insurance add-on you see when you buy a phone or a gadget. It sounds responsible. Protect your device. Who wouldn't want that? But read what you're actually buying. Many of these plans have a deductible, and it's often big enough that you'll hesitate to file a claim. They also have rules that make normal life feel like a disqualifier. Lost it? Sometimes not covered, or only covered under tight conditions. Mysterious disappearance can be treated differently than theft. Water damage may be covered, but only if you jump through steps fast. And the fine print can limit how many claims you can make in a year or cap the replacement value based on age, not what it costs today. Here's the sneaky part. The plan feels cheap when it's a small monthly amount, but monthly fees add up, and you can end up paying a large chunk of the device's cost over time, plus a deductible when you use it. Also, some purchases already come with protection you didn't notice, like manufacturer warranties for defects, store return windows, or coverage that comes bundled with certain payment methods. A smarter way to think about it is, if the worst case happens, can you handle replacing it without wrecking your life? If yes, you might be better off setting aside that monthly fee in your own oops fund. The people who win with these plans are often the people who break devices constantly and actually file claims. Everyone else is paying for a maybe. Next is number 14, the package protection or shipping insurance box you see at checkout when you order something online. It's presented like a normal part of buying, and sometimes it's pre-checked so you have to opt out. The reason this one can be useless is simple. In many situations, you already have protection through the seller, the shipping carrier, or basic consumer laws and card protections. Yet this add-on can shift the burden onto you. Instead of the store handling a missing or damaged item as a customer service issue, the store points you to the protection plan, and now you're filing a claim with a third party. That means forms, proof, photos, and waiting. Another catch is what counts as covered. But delivered can mean the tracking says it reached your address, even if you never saw it. Porch theft may require a police report. Damage claims may require keeping every piece of packaging. And if the plan pays out, it may pay in store credit or in a limited way that still leaves you short. The behind-the-curtain truth is that these add-ons are profitable because most claims are small, denied, or never filed due to hassle. Before you click yes, ask one boring question. What is the seller's normal policy if it arrives broken or never arrives? If the answer is we replace it or refund it, this add-on is often just extra friction you paid for. Now number 13, rental car insurance sold at the counter, especially the collision waiver and all the extra bundles they stack on top. This one is tricky because sometimes it's truly useful, but for a lot of people it's a duplicate policy sold in a stressful moment. You're tired, you're traveling, there's a line behind you, the agent is speaking fast, and the screen is asking you to accept responsibility for a car that costs more than your yearly salary. That pressure is the whole strategy. Many drivers already have coverage through their auto policy for rental cars, at least for collision and liability, depending on their specific plan and where they are renting. Some also have coverage through certain payment methods. The rental counter doesn't know your personal coverage, and they aren't required to optimize your finances. They're there to sell protection products. Where this gets useless is when you buy everything out of fear and end up paying for the same risk twice. There's also confusion about what each part covers. Collision waivers often cover damage to the rental car, but they don't necessarily cover injury claims or damage to other cars. Personal accident coverage overlaps with health insurance. Personal effects coverage overlaps with renters or homeowners insurance if you have it. And some of these products have exclusions that surprise people, like driving on unpaved roads, leaving the keys inside, or unauthorized drivers. The better move is to check your auto policy and any travel benefits before the trip, when you can think calmly. Then you'll know whether you need anything at the counter or whether you can decline confidently. Number 12 is flight insurance or travel protection, sold as a quick checkbox when you book a plane ticket. Again, sometimes travel insurance can be legit, especially for big, expensive trips with non-refundable parts. But the cheap, one-click version sold at checkout is often thin coverage with big exclusions. It's designed to feel like peace of mind, not to be a full safety net. One common disappointment is the reason you cancel matters. If you get sick, you may need documentation, and certain conditions might be excluded if they existed before you bought the policy. If there's a family emergency, it may have strict definitions of who counts as family. If you cancel because you changed your mind, that's usually not covered. If you miss a connection because you overslept, not covered. If your airline gives you a credit instead of a refund, the insurance may treat that as you've been compensated, even if the credit doesn't help you much. Another sneaky detail is that many of these add-ons cover events that airlines already handle under their own policies, or that basic consumer protections can solve. And travel assistance benefits can be more like a phone number that helps you find a doctor than an actual payment. The smartest way to judge this is not, do I feel nervous? It's, what exactly am I trying to protect? If it's a huge prepaid trip, a real travel insurance policy you choose deliberately might make sense. If it's a standard plane ticket you can change or take as a credit, the checkout insurance is often just a tax on your anxiety. Next, number 11. Accidental death and dismemberment policies, often called AD&D. You might see these offered through work, through a mailer, or as a small add-on. The pitch is simple. It's cheap. It pays a lot. The problem is, what has to happen for it to pay? It covers very specific kinds of accidental death or severe injury. It doesn't cover the most common ways people die, which tend to be illness-related over time. And it can have definitions that surprise people. Was it an accident, or was there a medical issue that led to the event? That distinction can turn into a claims fight. For injuries, the payout triggers can be narrow and tied to losing a limb, sight, or similar severe outcomes, not the more common, I broke my arm and missed work. Many people buy this because it feels like extra life insurance, but the protection you actually need, if you need it, is usually regular life insurance for people who depend on your income or disability coverage for loss of earning ability. AD&D often ends up being a product that sounds meaningful but sits in a weird gap where it doesn't match real-life risks. Now, number 10. Credit card payment protection or balance protection plans. This one is everywhere, and it's pushed hard because it's pure profit. The idea is, if you lose your job, get sick, or have an emergency, the plan will cover your minimum payments or pause them. Sounds helpful, right? But look at the cost and the limits. These plans often charge a monthly fee based on your balance, which means the more debt you carry, the more you pay for the protection. That's like buying more insurance the deeper you're already in trouble. Then come the conditions. Unemployment might only count if you were laid off, not if you quit, not if you're self-employed, not if you're a contractor, not if you worked fewer hours. Disability might require a waiting period and proof from a doctor. The benefit might be capped or limited to a short time. And sometimes the plan doesn't erase the debt. It just pauses or covers minimum payments, which can still leave you paying interest and staying trapped longer. In plain words, you're paying extra to keep paying. If you're worried about losing income, building an emergency fund and reducing fixed costs usually protects you more than a plan attached to high-interest debt. Number 9 is identity theft insurance, especially the versions marketed like they will cover you if your identity is stolen. Here's the uncomfortable truth. Identity theft insurance often doesn't reimburse you for money stolen from your bank the way people imagine. Many financial institutions already have fraud protections, and they handle unauthorized transactions through their own processes. What these policies often cover instead is the cost of help. Phone calls, case managers, maybe legal fees in certain cases, document replacement, and sometimes lost wages for time spent resolving the mess, up to limits and with rules. That can be useful, but it's not the superhero cape people think they're buying. Another reason it can be useless is overlap. Many people already get some monitoring and alerts through banks, credit bureaus, or basic services. And monitoring alone doesn't prevent identity theft. It just tells you faster. Also, some identity products sell fear with constant alerts that aren't real threats, just data exposure notices. The better approach is boring but strong. Use strong passwords, two-factor authentication, keep your devices updated, check your statements, and consider freezing your credit if you're worried. If you want paid help because you hate dealing with paperwork, that's a valid reason. But don't buy it thinking it replaces smart habits or guarantees reimbursement for everything. Next up, number 8. Mortgage life insurance sold by lenders. This is usually offered when you get a mortgage, and it sounds like a caring idea. If you die, your house is paid off. Who wouldn't want that for their family? But the structure often makes it a bad deal compared to regular term life insurance. First, the benefit typically decreases as you pay down the mortgage. So over time, it pays less, but your premium may stay the same. Second, the payout goes to the lender, not directly to your family. That means your family doesn't get to decide what the money should do. Maybe it's smarter for them to have cash to cover multiple needs like childcare, living expenses, and yes, housing. Third, underwriting and claim rules can be messy, and people sometimes discover coverage wasn't what they thought due to how applications were handled. Regular term life insurance is usually more flexible. You choose the amount, the term length, and your beneficiary is your family, not the bank. Mortgage life insurance is sold at the moment you're already signing a stack of papers and emotionally attached to the idea of protecting the home. That's why it sells. Now, number 7, disease-specific insurance like cancer insurance or other narrow illness policies. Let's be fair. If someone has limited health coverage or very high deductibles, a cash benefit policy could help with out-of-pocket costs. But for many people with solid health insurance, these policies are often overpriced for what they deliver, and they rely on fear. The coverage may be limited to certain diagnoses, certain stages, or certain treatments. It may pay set amounts for specific events, like a surgery or chemotherapy session, rather than covering the real cost. It can also have waiting periods, exclusions, and strict definitions that can lead to denial. Another issue is that it pulls your attention away from what actually matters: your overall health plan, your deductible, your out-of-pocket maximum, and your emergency savings. Those are the things that decide whether illness becomes a financial crisis. A narrow policy can feel like, I'm protected from the scariest thing. But real life isn't that neat. People face many kinds of health costs, not just one disease. If you want extra protection, it often makes more sense to understand your main health coverage and save cash than to buy a small policy that only triggers under a very specific scenario. Number 6 is hospital indemnity insurance, the kind that pays a set amount per day or per hospital stay. This one is often sold through workplaces during benefits season, and it's pitched as cash in your pocket if you're hospitalized. The problem is that hospital stays are expensive, yes, but the costs you're actually facing depend on your main health plan. If your main plan is good, the indemnity payout might be small compared to what you already handle well. If your main plan is poor, the indemnity payout might be too small to matter. That's why it can feel useless. It's often missized. There's also the question of when it pays. Some policies don't pay for observation status the same way as inpatient admission, and hospitals sometimes classify people in ways that surprise them. Some only pay after a certain number of hours. Some have caps. And then there's the human factor. People buy it thinking it will cover hospital bills, but it's not tied to your actual bill. It's a fixed benefit. If you love the idea of a cash cushion, you can build that cushion yourself with savings and get the same flexibility without the rules. The only time this product really shines is when someone has a plan with high out-of-pocket costs and little savings, and they're comfortable paying a premium for a chance at cash help. For everyone else, it's often another deduction that quietly drains your paycheck. Next is number 5, tuition insurance. You'll see this when paying for college tuition, and the pitch is, if your student has to withdraw for medical reasons, you won't lose the money. That sounds reasonable. But the reasons this can be useless are the exclusions and the timing. Many schools already have refund policies that cover some of the same situations, especially early in the term, and those policies might be more straightforward than an insurance claim. Tuition insurance also tends to cover only specific withdrawal reasons with documentation, and it may not cover academic issues, mental health situations unless very specifically defined, or a "we need to come home" family decision. It also may not cover room and board the way people assume, or it may cover only certain parts. And if the student can complete the semester but struggles, you might never use it even though the family had a tough year. The best defense here is knowing the school's own refund and withdrawal rules first. If the school already offers a clear, fair refund window, you might be paying twice. If the tuition cost is so large that losing it would be devastating, then sure, explore coverage carefully. But don't buy it as a reflex. This is one of those products that exists because the situation feels high stakes and confusing, not because the coverage is always a great value. Number 4 is pet insurance add-ons that aren't really insurance, especially wellness plans sold like they'll save you money. Real pet insurance, the kind that helps with big surprise vet bills, can be useful for some people. But the wellness plan style products often just prepay routine care with strings attached. They might cover things like annual exams, vaccines, or cleanings, but you may be paying the same amount you would have paid anyway, just spread out monthly, and sometimes you can only use it at certain clinics, or you have to follow a schedule perfectly. If you miss a service, you don't always get the full value back, and if you cancel early, you may owe money. The trick is that it feels like insurance because it's sold at a vet, or alongside insurance language. But it can act more like a subscription. You're not transferring a big risk, you're financing predictable costs. For predictable costs, a simple savings plan works better. Set aside money monthly for routine care, and you keep control. The only time these plans make sense is if you like the forced budgeting and you're sure you'll use every included service at the same place without interruption. Next, number 3, child life insurance policies sold as a standalone product, especially permanent life policies pitched as a gift or an investment for a kid. This is one of the most emotional sells in the entire insurance world because it touches the unthinkable. Let's say it clearly. The goal of life insurance is usually to replace income when someone who earns money dies. Most children don't have income that supports a household. So the main financial risk isn't there. Families may want coverage for funeral costs, and that's understandable, but there are often cheaper ways to handle that, like a small rider on a parent's policy or savings. The investment pitch is where things get messy. Permanent policies build cash value slowly, have fees, and are not designed to be a high-growth investment. They are designed to be insurance first. Some parents buy it to lock in insurability in case the child develops health issues later. That is a real feature, but it's usually not worth it for most families compared to simply making sure the parents are properly insured and financially stable. If your family budget is tight, buying life insurance on a kid while underinsuring the main earners is like putting a helmet on the passenger while the driver has no seatbelt. It feels caring, but it's backward risk management. Now number 2, home service line insurance for water and sewer lines that run from your house to the street. This one is popular because it targets a real fear: digging, repairs, and surprise bills. And yes, those repairs can be expensive. So why is it on a useless list? Because the way it's sold often makes it worse than it sounds. These policies are frequently marketed through mailers that look official, and people assume it's part of their utility. It usually isn't. Coverage can have limits: exclusions for older lines, exclusions for certain causes, and requirements for maintenance. It might not cover full replacement, landscaping, or certain kinds of damage. It might only cover specific parts of the line, and the premiums over time can be a lot, especially if your risk is actually low. Many homeowners don't even know what material their lines are, how old they are, or whether the neighborhood has a history of issues. If you're in an older area with certain types of piping and you know the risk is real, a carefully chosen policy could help. But for many people, the smarter move is to understand whether their homeowner's insurance offers an endorsement for this risk, understand their property's actual risk factors, and then decide. The useless part is buying it blindly because the mailer scared you, not because the numbers and the coverage make sense for your situation. And now, number 1. Cash value life insurance sold as an investment for regular people who mainly need simple protection. This is the heavyweight champ of confusing products. There are situations where permanent life insurance can be the right tool, especially for complex estate planning, business uses, or people with specific long-term goals and stable cash flow. But it's often sold to everyday households as a magic financial product that will do everything. That's where it becomes useless or even harmful. Here's how it usually works. You pay a premium, part of that goes to the insurance cost, part may build cash value, and there can be fees and charges that aren't obvious up front. Early on, cash value growth can be slow because of front-loaded costs. If you cancel in the early years, you may face surrender charges and walk away with less than you paid. Loans against the policy can reduce the death benefit and can create problems if mishandled. The biggest issue isn't that the product is a scam. The issue is fit. If what you truly need is affordable coverage for a certain number of years while you build savings, pay off debt, and raise a family, then plain term life insurance often matches that need cleanly. When a cash value policy is pushed as the default, people can end up overpaying for insurance, undersaving elsewhere, and feeling trapped because leaving the policy feels like taking a loss. The sales incentives here matter. These policies can pay higher commissions than simple term policies, which creates pressure to sell them even when they aren't the best match. The smart way to protect yourself is to ask basic questions in plain language. What problem is this solving that term life plus regular saving doesn't solve? What are the fees and surrender charges? How long before the cash value equals what I put in? What happens if I miss payments? What's the realistic outcome if I keep it for 10 years versus 30? If the answers are fuzzy, that's your answer. Let's recap the big takeaways. The most useless insurance policies are usually the ones you buy in a hurry, at checkout, or in a moment of fear. They often duplicate coverage you already have, hide exclusions behind comforting words, or solve a small problem with a big monthly bill. The fix isn't never buy insurance. The fix is matching the product to the real risk. Big, rare, life-changing losses are what insurance is good for. Small, predictable costs are what savings are good for. If you made it to the end, hit like and comment this. Which insurance policy have you been tempted to buy lately, and what did the salesperson or the checkout screen say that almost got you? And share this with one person who always clicks Add Protection without reading anything.